Namaskar, Dosto. Welcome to our special episode on the Indian Income Tax Act of 1961. Today, we'll unlock the mysteries of this important law. It's the backbone of our tax system. Every working Indian needs to understand it. The Act has seen many changes over the years, but none as big as the recent introduction of the new tax regime. Now, taxpayers have a choice. They can stick with the old system or opt for the new one. The Indian Income Tax Act came into force on April 1, 1962, replacing the earlier Act of 1922. The main goal was to streamline tax collection and make the process fairer. The introduction of the new tax regime in 2020 is the latest big change. Now, let's look at the old tax regime. The old regime has a progressive tax structure. As your income increases, so does your tax rate. Individuals up to 60 years old pay no tax on income up to 2.5 lakh rupees. From 2.5 lakh to 5 lakh, the rate is 5%. It goes up to 30% for income above 15 lakh. Deductions like Section 80C investments can lower your tax burden. Let's move on to the new tax regime. The government introduced it to simplify the tax system. It offers lower tax rates, but you have to give up most deductions and exemptions. The new regime has more tax slabs. For 2023-24, there's no tax on income up to 3 lakh rupees. Then, it starts at 5% for income between 3 to 6 lakh rupees. The highest slab is 30% for income above 15 lakh rupees. One big change is the standard deduction of 50,000 rupees available to all taxpayers. This can be particularly beneficial for those who don't claim many deductions under the old regime. The new regime is optional and can be chosen if it benefits you more. It's especially attractive for those who don't claim many deductions. The simplified structure can make tax filing easier. Section 4. Comparing old and new. Key differences. Now, let's play a game of spot the difference between the old and new tax regimes. The first major difference is in the tax slabs. The new regime has more slabs, making the tax structure more granular. The second big difference is deductions. The old regime offers various deductions and exemptions that can significantly reduce your taxable income. The new regime offers very few deductions. Another key difference is the tax rates. The new regime offers lower tax rates for most slabs to compensate for the lack of deductions. Lastly, there's a difference in complexity. The old regime can be complicated with its various deductions and exemptions, requiring more paperwork. The new regime is simpler and easier to understand. It's like choosing between a complex strategy game and a simple, straightforward one. Section 5. Weighing the options, pros and cons. For the old regime, the biggest pro is the ability to claim deductions, which can significantly reduce your tax liability. However, the old regime is more complex and has higher tax rates compared to the new regime. Now, let's look at the new regime. Its main advantage is simplicity, with lower tax rates for most slabs. This can be beneficial for those with fewer deductions or those who prefer a hassle-free tax filing process. But the new regime has its drawbacks too. The biggest con is the loss of deductions. If you're used to claiming substantial deductions under the old regime, you might end up paying more tax under the new system. It also doesn't incentivize long-term savings and investments like the old regime does. It's a trade-off between immediate tax savings and long-term financial planning. Section 6. Making the right choice. Tips and examples. Consider your unique financial situation. Calculate your tax liability under both regimes. Use the Income Tax Department's official calculator or consult a tax professional. Consider your life stage and financial goals. The new regime might be beneficial if you're young with few investments. The old regime could be better if you have a home loan or significant investments. Always consult a tax expert for personalized advice.